Hi, I'm Batu from freefincal, and today let's talk about what is a rolling return and how to calculate it and what is it used for. So this is a question that readers have asked me often, or viewers have asked me off and on over the past few years. My standard answer is look at my free calculator, which is available with which you can evaluate any fund the way I do, and viewers would be aware that I often use rolling returns to evaluate mutual fund performance. So to understand what exactly a rolling return is, let me straight away get into the example so you can understand that. So what you see here in column and B is the date and Sensex price since inception, or since the not since inception, since the date was first calculated, 3rd April 1979. That's just the price data, but that doesn't matter here. Dividends are not included, but that doesn't matter here. So let's say I want to find out what is the 20-year return from the Sensex, from the price index, and I want to find out every possible 20-year returns in the past. So to do that, so I now have 3rd April 1979 as my first date. Sensex was 124.15 on that date, and I want to look at a date 20 years later. So after 20 years, the date I'm looking for is 30th March 1999, and the Sensex was 3,683.49, the close price at that on that date. Of course, it will not be exactly 20 years because there will be holidays and so on, but you can actually find out. So what I've done is, from this list, this has got you can see here how many. Oops, I hate this in Mac. I can never get used to it. So this has got about 9,357 entries, and from these entries I need to go back up. I can never get used to the keys in Mac. So from these 9,000 odd entries, I have taken an entry which corresponds to 20 years after 3rd April 1979, and that is this, and that's the price. Similarly, I go to the next business day, which is 4th April 1979. Look at the date, which is after 20 years. Sometimes I'll get the same date, but that's not always going to happen. Again, it's the same thing, but you can always shift it +1, -1. It doesn't really matter. You don't have to worry too much about it. 6th April, 7th April, and so on. You can see the dates keep going, and you can see here once you go to 8, for example, here 18th September, and that's 14th September 1999, and so on. It keeps going. So this list of from date, initial price, to date, final price should be first tabulated. You can tabulate this using a combination of two Excel functions called index and match. These are awesome functions. These changed my life, the way I do calculators. You can learn more about how to combine index and match to get particular data from an array like this. So once you have this, I can now calculate the absolute return. So I can say 3,683.49 minus 124.15 divided by 124.15. That's the absolute return, and I can calculate the absolute return on all the days. Notice that the absolute return for over a 20-year period gets rolled over by a day, by the next business day, and that's called a rolling return. So absolute returns can look very awkward because some of these numbers can be very huge. Instead of that, we can also calculate the annualized return, or the XIRR. The simplest way is to use the XIRR function. So in order to use the XIRR function, I've written you can see here, I have entered the initial date, final date, initial price, final price, but the final price is entered with a negative sign because in XIRR, this will be considered as the payment, and that will be considered as the money that you get outside, or you can put the negative sign here also, it doesn't matter. So one of the price entries should be negative. So that just means that you are buying at 124.15 and selling at 3,683.49. That's what it means. And there, in order to differentiate between the buying and selling, there's a negative sign. You can put the negative sign here, or you can put the negative sign there. It doesn't matter. And then you combine these entries and calculate the XIRR. The annualized return over that 20 years is 18%. And then if you copy this down, you will get the XIRR on a rolling basis. So 20-year return rolled over by moved from one duration to the other by 1 day. You can also have monthly Sensex data and calculate 20-year returns, or weekly Sensex data and calculate 20-year return, or any other duration that you want. So if you do this and plot it, this is what you will get. This is what we considered yesterday. Notice that there are like 4,386 data points in the pink line. Each of them is a 20-year return. So when I look at just one index, the first thing that tells me is what is the maximum return and the minimum return, and that's the spread. Many people make the mistake of calculating the average of rolling returns, especially mutual fund companies. That's completely wrong. You can use the median. It's wrong because the average is wrong because this is not a bell curve distribution. It doesn't have an average. You can use the median of this distribution, which tells you the midpoint, which is the bottom half, and which separates the bottom half returns from the top half returns. But even that is not really of any use. It just tells you what is the spread in the 20-year returns possible or in the past. And so it's a measure of not only returns, it's also a measure of risk. And that's why it's a visual measure of risk. That's why I love the rolling returns representation. Also, when I compare the fund, I can do the rolling returns analysis for a fund, and I can also do it for an index and plot them together. And when I plot them together, I can see here the blue line is the fund. I can say that the fund outperformed the index in this region, underperformed in this region, outperformed in this region, and then underperformed since then. And so I can find out in what regions or when it outperformed and when it underperformed. I can find out how consistently the fund has been able to beat the index, and this is what I use in my mutual fund screeners that I publish every month. So that's how a rolling return is calculated, and that's how it's used. It's a measure of risk, and it's also a visual measure of risk, and it's also a measure of how consistent some security, whether it's one stock or one fund or anything else, has been able to beat another security, which is an index or anything else that you want to compare with. So that's how you do. So you will basically take the price data, and then from that price data you find out the period over which you want the rolling return over, and you extract the date, that is a date that is 20 years later, and then find out the price on that date, and then calculate the absolute return or the annualized return, however way you want. Initially, when you look at older indices, they may not be available on all dates. There will be gaps in the middle, and then when you have such gaps, the end date will be the same for a few days, but it doesn't really matter. You don't need to worry, break your head on that. It's not going to make a big difference to the result, but that's how it's done. Especially when you do it automated, you can't be worrying about all that nitty-gritty. So that's what a rolling return is. I finally said it. Not many people will watch this, but then for those who are interested, I hope this is useful. If you have any questions, please let me know. Bye-bye.